I am here to provide an update on the crashing stock market. In today's video, I want to discuss 3 fundamental changes that have recently occurred that, in my opinion, literally change the fundamentals. They change the game, if you will. There are fundamental changes happening right now that investors should be aware of, in my humble opinion. And so those 3 fundamental changes are the health stuff that we're all aware of, the recent federal funds emergency rate cut of 0.5%, and the fact that OPEC, and in particular Saudi Arabia, is intending to flood the oil market with more volume, sending Brent crude futures down to the low 30s. So those 3 fundamentals are changing the way I look at the game as a long-term dividend investor. And so I want to address that in today's video, how my strategy evolves over time, synthesizing and taking new fundamental changes into account. I also just want to discuss my overall survival guide, my overall guide that I'm personally following for the 2020 stock market crash. And I'll tell you, I recently did 2 videos and a number of people were commenting, Ian, why are you calling this a crash? Because both of my last 2 videos, they had crash in the title. The reason I'm calling this a crash is because I think it is a crash. We are still in the middle of it, in my humble opinion. We have further to go. I think markets will fall further. I think certain stocks, such as the oil sector, may face even more downward pressure than that sector already has faced. And so I personally see that we're in the middle of all this and that it will be a crash, if not already. We keep falling each day. And certainly there's going to be some up days, some down days, but I certainly look at this as the 2020 crash. Now, is that a horrible thing? No. As a long-term dividend investor, sometimes I get excited by things like this because the lower the stock prices are, the better entry point that I can get, higher my starting yield, better long-term success from a financial perspective. Now, obviously, I don't want to make light of a situation that is creating a lot of chaos out there, a lot of health issues out there. Obviously, my prayers go to those facing health issues and, quite frankly, those now facing some financial challenges, those getting overwhelmed or concerned about stock market volatility, because all of that stuff, it could create a lot of pressure for investors out there. But for long-term investors who have a really long-term time horizon, I do believe there's a very good opportunity on the table now. I'm certainly stepping up to the plate. I'm doing it in a calculated way. I'm focusing on my ride or die stocks. I'll talk more about that later. And I picked up more shares of 3M today, for example, which I will discuss a bit later in today's video. So this is a emergency video, if you will. I'm just kind of putting this together really quickly so I can get it out in real time to everyone, because I know a lot of you have been surfacing questions, observations, thoughts in the PPC Ian community. And I wanted to take an opportunity just to get this video out there. So let's get started. We're going to jump right into these 3 fundamental changes first. All right, so I'm going to start with oil because that's the one I'm getting a lot of questions on, and that is a change that happened literally just this past weekend. And so there is a oil cartel called OPEC. I'm sure all of you are aware of this. And basically OPEC meets, and there's OPEC-related entities as well. They sit down at a table, they determine how much output they are going to drive in terms of oil production. And by throttling output, what OPEC does is they help set the price of oil. And so what happened is Saudi Arabia and Russia were meeting recently, and Saudi Arabia was suggesting that we cut back, or that OPEC and OPEC-related entities cut back oil. And they were saying to do that to keep the price high in this environment right now where oil has already been a little bit weak. Oil's already been trending down a bit. Why? Because of this nasty health stuff that's going around. Economic activity already is slowing down a little bit. And with lower economic activity, there's less need for oil. And so oil's already under pressure. And so what Saudi Arabia was suggesting is, hey, Russia, let's try to throttle back our production a little bit. Well, what had happened, and again, I'm just synthesizing what I read in the news, and so I'm not a first-hand expert on this by any means, but what I read, at least in the news, is Russia said, no, not going to do it, not going to cut back production. And so Saudi Arabia countered that with, okay, you're going to mess with me, we're just going to flood the market with oil then. And so that's basically what I've synthesized of all this. And it sent Brent crude futures plunging to the low 30s, which is really bad. And it's reminiscent of those low oil prices from a few years back when OPEC was playing these games in the past. I know OPEC a few years ago flooded the market with oil. And the reason for that a few years ago is to try to send a strong message to U.S.-based fracking producers who were coming up to the market and creating new supply in the market. And OPEC was trying to drive some of the lower cost or lower margin producers out of business. And so it seems like that situation from a few years ago is resurfacing, and the price of oil is going down in a major way. And so I want to tell you what I plan to do with this information, what I plan to do with this fundamental change. And so before I do that, though, just a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. I'm literally just sharing my journey here on YouTube for fun and entertainment. And please keep in mind, anyone can easily lose money in the stock market. Stock market is very volatile. I'm just sharing here on YouTube my own journey, my own situation. And my own situation is probably very different from many other people's. And so just wanted to add that up front. But what am I doing with this information? And a lot of you are asking because, Ian, you were just buying BP. You were just buying Royal Dutch Shell not too long ago. You were buying them and you were excited about them. And now they're at much lower prices. Are you going to add more shares? Here's the deal. I'm not buying any more oil. I'm done. And I'll tell you why. The reason why is there's been a fundamental change. When I was buying Royal Dutch Shell and BP earlier this year, Brent crude was really stable. Price of oil foreseeably was at the $50 range or higher. And at $50, the oil super majors that I own, they can do really well. They can make a lot of money. And the challenge here is already with the health stuff, price of oil is tapering off. Now with this uncertainty around OPEC and Russia and their negotiations, oil is even further. And it seems like Saudi Arabia is going to do a repeat of what happened a few years ago. And I know from a few years ago when the market was flooded with oil, prices go down. And so with those low prices, a lot of the types of companies I own, like BP, Royal Dutch Shell, at a certain point, they become unprofitable. They start losing money. And at that point, it's a waiting game. They start thinking, is oil going to recover quick enough? If it does, they just keep paying the dividend and kind of pay for it out of debt. But if oil does not recover, at a certain point, they have to start thinking, can we maintain these dividends? Can we keep paying them? The problem I have is these oil companies, they're already not prepared for this. They're not. They already had an oil supply crisis just a few years ago. They're still recovering from that. The balance sheets are not in a position to take this on. And we saw that today with the stock Occidental. This is one I recently did a video on. And I was explaining why it wasn't for me, and I didn't like the capital structure between Berkshire Hathaway, Buffett, and Occidental and Anadarko. I didn't like that all played out. I'll link to this video in the description below. That stock, because their debt structure is just really unfavorable, dropped 50% today in one day. And I wouldn't be surprised if it drops more. I think they're in real trouble. And again, I'm just sharing my personal opinion. I could be completely wrong here. Maybe it's the best opportunity to buy oil now. I just don't know. But for me, the way I look at it when I take a step back is, look, these guys are already recovering from a crisis a few years ago. They needed more time to recover. They did. The new crisis is coming on way too soon, way too aggressively. They're going to all start losing money again. And a lot of them will weather the storm just fine, but some of them won't. And personally, I'm preparing for dividend cuts at companies like Royal Dutch Shell and BP. I think my holding in Chevron, they probably won't. They'll probably be just fine. But those other two, honestly, it may be prudent for them to cut the dividend and to preserve cash flow to operate their business without digging into too much more debt than they otherwise would have to. And so now you may be asking, Ian, are you planning on selling? Absolutely not. So I need to redo my portfolio and share an updated portfolio with all of you. It's been a while, but I did a quick back of envelope calculation this morning. And it may even be, it's not perfect, but what it showed me is my exposure overall to oil in my portfolio. It's kind of 5%, that kind of range, 5% of my overall portfolio value, and shrinking obviously as oil stocks are plummeting. And so for me, I'm okay with that 5% exposure. I don't want it to be too much more. My bread and butter has always been, will always be household names, consumer non-cyclical type companies. And so for me, I like the exposure to oil. I like it for the juicy dividends, but this is a fundamental change that I flat out did not know. No one knew when I was investing in some of these oil stocks, adding some shares earlier this year. And now with this fundamental change, for the reasons stated, it's just not for me. Now, hypothetically speaking, I'll tell you, if I had a portfolio and I had no exposure to oil, I would probably take this opportunity myself to add exposure. And if I didn't have 5% in oil already, I'd do that. I'd go ahead and put 5% or average in, obviously, but I'd build up an allocation. But now that I already have 5% of my portfolio value in oil in the energy sector, I like having the exposure. If you've been watching my channel, you know I'm a big proponent of that sector. I think very highly of people who work in that sector, especially the people working so hard on the rigs. Bless you all. But for me right now, for my own personal situation, it's just not the right time to add to oil stocks because of this fundamental shift. But again, if I had no exposure, I'd be thinking about it really differently. But I need to take a step back here and think holistically about my entire portfolio in all of the sectors. And so it'll be interesting to follow what happens, but that is fundamental change one. So fundamental change two, I want to talk about the federal funds interest rate. So Federal Reserve recently met on March 3rd, and there was an emergency rate cut. This was the first emergency rate cut since 2008. This is a very big deal. And I know the Federal Reserve, President Trump, trying to get ahead a bit of this nasty health stuff, this epidemic that we are all faced with right now. And so in doing so, though, people think, oh, this is good. This is a good thing. Interest rates are lower. It's good for businesses. And this very well may be so for certain businesses. I'm going to talk about that in a minute. But for other businesses, it's not. And I'm mainly speaking about the finance sector now. So for me, oil, I'm done. I'm not adding more. Finance sector, aka banks, going into this year, I was excited to build a position in Wells Fargo. It's a real small position in my portfolio. The value of it is less than 0.5%. I was hoping to bring it up to maybe nearly 1%, somewhere between 0.8% and 1%. At this point, and I have a few other bank stocks as well, if you've been following me for a while, you know those. I am at the point where I'm done. I'm not building any more Wells Fargo. I'm not building any more bank stocks. I'm done because there has been a fundamental shift. And I think the fundamental shift, people are in some respects, they're ignoring this, but the way a bank works is they take on deposits, and a deposit becomes a liability to them. They take on my money in my savings account, for example. They take the deposit and then they use the money and they lend it out. Maybe they lend my same money back to me on my mortgage and they charge an interest rate on the mortgage. Now, the challenge is when the federal funds rate drops, and it drops as significantly as it did by 0.5%, and they might even drop it more, it makes the banking business that less profitable because we already know these banks, they don't pay much interest on savings accounts, at all. Where the margin is coming is on the loans that are going out. And Wells Fargo, it's kind of like a community loan banking type institution. And so a big portion of their business, it's mortgages. And we know there's a refinance boom right now. And we know that as interest rates are going down. And so their spread, the amount of money these guys are actually making, it's going to go downhill. And so this is a fundamental shift. Going into this year, interest rates already at historic lows. Did I think that the Federal Reserve would drop it even more? I mean, they're now targeting a range here of 1 to 1.25%. This is really low. And honestly, it doesn't leave them a lot more room to drop rates. If things get worse, what are they going to go past zero? Maybe. I would be shocked if that actually happened in the United States, but you never know. But for me, look, when I was building up Wells Fargo earlier this year, this data, no one could have envisioned this. Now it's happened. There's been a fundamental shift. Done. I'm not going to sell. I'm going to reinvest dividends, but I'm not adding more to my banks and my finance stocks right now. And so this is how in real time, as life evolves, as crisis unfolds, I look at the facts and I allow them to influence my investing. Now, you guys know I'm the biggest advocate of long-term dividend investing around. Does this mean I just kind of sit on the sidelines or I get all concerned? No, I know banking and oil will eventually come back, but honestly, those were never sectors that were core to my portfolio. And given these fundamental changes, I'm learning as this process goes. I become a better investor every day, and I hope at home you guys are doing the same. You're taking this opportunity to up your game, to learn new things, to learn from the crash. I explained in my last video, which I'll link to in the description below, that I personally look at a crash as condensing time, shortening time. People learn more quicker because there's so much going on. And one of the things I've learned really quickly is I just want to focus on my ride or die stocks. I'm going to talk about that in a minute. But oil stocks, banking stocks, those aren't on my ride or die. They play valuable roles in the portfolio. I'm glad to diversify and have that exposure because one day, 10 years from now, there may be another crisis. And in that crisis, all the sectors that are hurting, it might be other sectors, and oil and banks, those might be the only sectors that are doing all right. And so that's why it's great to diversify. And I love having the diversification. But again, change one, no more oil for me now. Change two, banking. But again, if I had zero exposure to banks, maybe I'd build up a little exposure here right now. Maybe I would do that. But personally, I've got exposure. I'm okay with it. I don't need to add more, but I will reinvest my Wells Fargo dividends as the position's small and I like to build it a little bigger. Now, the third fundamental change, obviously, is this whole health stuff. I think a lot of people are underestimating what this can do, but we know as of today that the entire country of Italy is under quarantine. Everyone. This is pretty darn serious, and so whether you believe that this is a health risk or not, I know a lot of people, they're not concerned about the health stuff. I'm no medical doctor, so let's just put that aside. I want to talk about the economic side of things. Economics here. People are on quarantine. They can't leave their house. Economic activity is starting to grind to a halt. A lot of businesses around here in the Bay Area, they're telling their employees, don't fly. Don't fly for business travel anymore. Work from home. Don't come into the office. And I imagine over time that there are going to be winners and losers in the stock market from this type of scenario. Obviously, you got the winners out there. If anyone was at a supermarket over the weekend or a Costco within the last week or two, you know, Clorox, all the wipes are gone. And Clorox stock, one of my holdings, is hitting all-time highs. We know that General Mills, I think that stock will do well. People are going to eat at home more. They're going to buy consumer packaged goods. They're going to stock up on extra consumer packaged goods, just to have a little extra stock in case they have to stay home. Look at Italy. Everyone's at home, can't leave. And so certain stocks like Home Depot, 3M, they'll probably do all right because people are going to Home Depot to buy supplies for their home, like 3M masks, although those are all sold out. But thankfully, they're rising to the occasion. They're trying to produce more. And hopefully, the masks, first and foremost, get to the medical professionals, the first responders who need them the most. That's what I hope for. But those are examples of stocks that I think will do all right. But you have other stocks, like some of my favorites. I'll tell you, I don't want to get down on my old friend Starbucks, but I love Starbucks. And I just bought more recently. I'm already down. It's going to go down more. It'll probably plummet. I'll average down. But think about it. If the fear factor kind of gets high enough, people aren't going to Starbucks. They're going to wait it out. They don't want to get sick. People aren't going to go to McDonald's. They're going to wait. And so there's going to be winners and losers. But in general, my belief is the panic factor is pretty big now, and it's not going away anytime soon. And so my belief is the third fundamental change in our market here is that economic activity is going to slow, and that slowing economic activity is going to push the stock market down. The stock market is forward looking, and so it's already adjusted quite a bit on the premise that things are going to look pretty bleak. But I think the market hasn't finished adjusting. We're going to see some more downward activity. And so for me, the way it changes my strategy is I'm just literally focused on my ride or die stocks. One of the things that kind of lessons that came out of all of this is there's certain stocks that I love the most. I have 44 stocks and they all play a role in the portfolio, but I want to focus on my ride or die stocks because those are the ones I care about the most. Those are the ones that drive the results for the portfolio, the bulk of the results over the long run. They will continue to. They're the ones I want to focus on. And so literally what I'm doing, what my strategy is for the coming weeks, months, years, is literally focus on my ride or die stocks. Look at the market each week when I got some money to deploy, see which one is on sale the most, which one makes the most strategic sense, and just keep dollar cost averaging in. I'm going to keep calm. I'm not going to worry about things. Quite frankly, I'm going to be excited because there's going to be some opportunities there. There already is. Although when you look at my ride or die stocks, my favorite stocks, they're not down much like some of the oil and banking stocks. But again, the reason oil and banking are down so much is there's literally been fundamental shifts in those sectors that I don't think are quick fixes. I just don't. Oil, I think it would be a quick fix if the crisis didn't already happen a few years ago, but they're still recovering from that. So this is another blow to that sector when that sector just is not ready for it. And we're seeing that being reflected in stocks like Occidental go down 50% in one day. Now, I pick on Occidental, but if you're in it, I wish you all the best. I wish it a full recovery. I certainly send my prayers and well wishes to anyone investing in any stocks. I want to see people succeed. Now, I'll tell you, I'm just going to throw it in there because people, like I said, this is a little bit more of a freestyle video today. I was getting some questions on my Facebook group earlier about Cedar Fair. Ian, what do you think? Cedar Fair, it's not on my ride or die list. It's not there. And so I'm not going to be buying any more Cedar Fair anytime soon. And the interesting thing about Cedar Fair is it's plummeting. It's plummeting a lot like Carnival Cruises. And I did a video on that a while back. I'll link in the description below. I wouldn't go near that, personally speaking, ever, as I discussed in that video a few weeks ago. But certainly I wish anyone in it all the best. And like I said, I could be completely wrong. But Cedar Fair, it's an amusement park company. A lot of their locations don't even open until, say, May, June, like once the summer gets gearing up, spring, summer. And they announced record 2019 earnings. I did a whole analysis on it recently. I shared it in a recent video. And they've been selling a record number of season passes for 2020 ahead of time. So that company in that sector is positioned really well. But this fundamental change with this whole health stuff, I can foresee already that their business, it probably won't do as well in 2020 as everyone thought when they announced their earnings. It just won't. People are going to be fearful. They're not going to go. They're not going to show up at the parks. And so they're going to have a rough year. I wouldn't be surprised if they cut the dividend. And quite frankly, I would encourage them actually to cut, and it shouldn't be called a dividend, it's a distribution because it's an MLP. I would encourage them to proactively cut it. I would encourage BP and Shell to do the same because I would rather see these companies bolster their cash to get through the crisis than to pay too much out. Because a dividend cut, quite frankly, for someone like myself, I'm not relying on those dividends quite yet. I mean, I'm using some of them to pay my bills, but one, this is why I diversify. I have 44 stocks, but two, to forego dividends, say for 1 or 2 years, I would rather do that and just get the pain over with and put them in a better situation for the future than to have them hang on here and tough it out and take on even more debt. That's just my personal opinion. Others might think otherwise. But for me, people ask me sometimes, Ian, if there's a dividend cut, is an automatic sale? Do you sell the stock? No, I do not. With a dividend cut, that is not a trigger for me to sell a stock. I'm at the point in my portfolio where I will just hold forever. I've done my fundamental analysis. I feel good about what I hold. I'm talking negatively today about the banking sector, the amusement parks, the oil companies, but I own them and I love them. And to be in my 44 stocks, stock better be pretty special. But for me, where I'm at now, I'm not going to be buying more Cedar Fair because I do feel that the fundamental change of this health stuff, I'd rather just see how it plays out first, because I wouldn't be surprised if it drops a lot more and that a cut on the distribution may be ahead, but we shall see. Certainly, I don't want to create fear in the community, and I don't want to convey that I'm in a place of fear, because I'm not. I'm just not. And I'll tell you, even if there are some dividend and distribution cuts around the corner, this is why I own 44 stocks, and quite frankly, I'm going to also see some increases across the rest of the stocks, and I'm pretty sure that year over year, I will still come out ahead in terms of my dividend income growing up and to the right. And that's what's so exciting about being a dividend investor, because even in times like this, where we're in the middle of a crash, and there's not one change, there's not two changes, but there are three economic changes happening right now, perfect storm, all at the same time. Even with all that, I rest assured at night that my dividend portfolio income will serve me well and will grow year over year over year. Maybe it won't grow as much as it has in the past recent years. It might slow down that growth a little bit, but that's okay, because we are in some pretty uncertain times right now. But I'll tell you, what am I doing with all this information? I'll share on the screen. These are the stocks I'm focused on. Now, a lot of these stocks, these ride or die stocks, they haven't corrected a lot yet. These are premium companies. And if I look at the list, some of these guys are going to do just fine during this crisis, like J&J. Yeah, they provide the very health and medical supplies and drugs and equipment, machinery to get us through this stuff. And so I think they're going to do just fine, although they are trending down a little. And if it does trend down more, they're kind of at the top of my list for buying, because I think they're in a reasonable PE range. Pepsi, I think they'll do just fine, because I think with more people staying at home, they're going to be buying more snack foods, more sodas, more products, Gatorade, for example, to get those electrolytes if you're not feeling so good. So I think Pepsi will do fine. McDonald's, I wouldn't be surprised if there's a lot of downside ahead for McDonald's. And if there is, I will jump in. Man, will I back up the truck for McDonald's. I think people at a certain point may be fearful to go to the restaurants. We'll see. We'll see how that goes. Clorox, they're up and to the right. I don't foresee myself being able to buy more shares, hitting all-time highs. I think that will continue, and I commend them. I'll tell you, someone recently brought this point up, and I just have to comment on this. Someone was saying, Ian, you keep commending like 3M for doing all this good out there, doing these masks. But Ian, did you know they're only doing it to make a profit? Here's my answer to that. There can be a win-win-win situation. 3M, they deserve to profit. This is capitalism. They should profit, not overly profit and not raise prices ridiculous or anything like that. But if they charge a fair price, as they are, for their product, they should profit, because they're doing good out there. They're a business. They're in business to make money and to serve society, so they deserve to profit. Now, they produce these masks and they go into overdrive. They produce more masks. Employees win because they're working longer hours, so that's a win. Who else wins? The medical workers win because they're getting the masks that they need to protect themselves and to serve society. And the investors ultimately win because it's a company that's going to do good, perform well financially. And so for me, that's how I look at it. Any of these companies, you may say, Ian, do you feel good about profiting on Clorox out of all of this? And I would say yes, because they're serving a need. The reason I'm profiting is because Clorox is up. The reason Clorox is up, quite frankly, is they're doing good. They're doing good things. And yes, as a business, they're profiting as they should. They should profit for doing what they do in society. But again, my humble opinion, I know a lot of people disagree, but I had to throw that out there. So Duke Energy, I have a utility on here. I could foresee having a buying opportunity there. This is one of my top 10 favorite stocks. And so number 6 to be exact, there could be a buying opportunity. Energy needs in terms of electricity from a local regulated government utility, I don't see that changing dramatically. And so this could be one of them. If this goes down, it's kind of like Pepsi. It's one of these things that just gets caught up in all the drama. And because it gets caught up, it goes down. And this is the key difference I want to point out. Two types of stocks now. There's stocks that are going down because they're fundamentally in trouble. Oil stocks, banking stocks. I'm just telling you. Cruise ships, come on. Amusement parks, I own it. They got fundamental problems. But when I see a company like Duke go down, they're not facing fundamental problems. What's happening there in that kind of case is it's just getting caught up in the hype. And that's the difference. That's the difference when you're an investor and you kind of look at things. I like to buy the stocks that are crashing for no good reason. I do sometimes buy stocks that are crashing for a reason, like the oil stocks are, but honestly, there's too many reasons now with oil. They're already, as I already talked about at length, too many reasons. And so there's a difference here. And what I'm trying to pinpoint as an investor is my premium stocks. Some of them will go down for a reason. Like McDonald's, it'll go down because no one's going to go to the restaurant. That's my opinion, or fewer people. It'll be down for a reason. And I'll still buy it because it's McDonald's. But Duke, if it goes down, literally, I think it's for no good reason, and I'll buy. Procter & Gamble, I don't foresee myself getting into this one in this market at a good price. I just don't. Again, people are stocking up on everything they make because they're staying at home. Coca-Cola, same thing. Look, if Coca-Cola or Procter & Gamble, they go down in share price, they're going down for no good reason, in my opinion, because fundamentally speaking, the fundamental changes in our economy, not only the three I discussed, not only do they not hurt Coca-Cola, they may benefit Coca-Cola because more people are at home and they're at home just drinking Coca-Cola and getting that sugar fix because they're of all this madness going on now that is really consuming people. And 3M's a unique one. They are affected by one of the changes. I would say really the health-related change. It's kind of lowering economic activity a bit. And 3M is a B2B company, and so they're facing some challenges. I mean, they're big in the aviation industry. They're going to have issues there, but on the flip side, they're doing better in their mask division, in their protective gear, goggles, apparel. That stuff is doing better, and so it's kind of a tale of two or three different business divisions there, all going different ways. But 3M, the way I look at it, so diversified. Yeah, they're kind of in a cyclical downturn, but it's a good time to buy. And for me, at least, my position's only half of where it needs to be anyway. So I want to build it up a lot bigger. And you may notice some of you have been asking, Ian, where's United Technology? I don't want to talk about it too much, but I love it. I own it, but it's not in my ride or die intentionally. I didn't just leave it out. It's not in there. I don't want it in there. And so because United Tech isn't in there and 3M is, and it's the only industrial in there, I'm all about doubling down on 3M these days. But again, I don't sell, so I own 44 stocks. How do I kind of reprioritize? It's with new capital. It's where I put capital, and that's why I'm focused on these stocks here that mean a whole lot to me. Okay, Kimberly-Clark, same thing as Procter & Gamble. If it's down, it'll be down for no reason because everyone needs the paper goods that they make right now, the Kleenex tissues, the toilet papers, all that stuff. And so they're stockpiling it, in fact, and they're serving a need there. They're preparing people for something that may be to come, where people are staying at home. And so, if that stock goes down, it's going to be pure senselessness. And when a premium company like this goes down out of pure senselessness and the fundamental changes in the economy don't even affect them, in fact, may benefit them, that's a buying opportunity in my humble opinion. Starbucks, it very well may tank. Like McDonald's, people are going to be more cautious. I've been kind of just checking Starbucks the last few days. They seem pretty busy. That may not continue. Here in California, at least, that may not continue. And I'm prepared for that. I'm prepared for it to go down. I'm prepared, quite frankly, I'll tell you all, for those traders on the trading floor to wear Dow 20,000 cap again. I remember when they were wearing Dow 20,000 on the way up. I don't know if they held on to them. You're going to be putting your Dow 20,000 on again on the way down. And so that's what I'm prepared for. I shared that with my homies at the recent meetup. But that's okay. For those who have a longer term time horizon, again, these periods of prolonged, even if this downturn, this crash is prolonged, they can create a lot of opportunity. And so for me, that's how I approach it. I look forward to the opportunity, and I look forward to buying some of these ride or die stocks in particular on value, like I did with 3M today. Home Depot, again, that one, who knows? I have a theory with Home Depot. I think it's going to do just fine. And maybe I'm wrong, but my theory is that the whole real estate market's going to soften potentially. Now, because of low interest rates, maybe it won't, but I also fear because people are more skeptical about moving right now. That's a big life change, and people might be feeling a little more uncertain about their income, their jobs. People might be feeling a little bit more uncertain just what's to come. So real estate new home stuff might slow down, but if you're already in a home, you're still going to need to go to Home Depot to get all kinds of stuff and fix up what you got. And so I don't know. Home Depot also does well when people are moving and going into new homes and need to fix stuff up. And so I personally believe Home Depot could do well in either situation. But again, if it goes on sale, I will add. And so what do I literally do on a week-to-week basis here? I've got money to deploy. Like I said, I just look at these stocks in my ride or die list. These are the ones I'm really focused on. This is what I'm focused on going forward. And by having a short list, it just makes it easier for me. I'll tell you, the voice in my head today was saying, Ian, you ought to buy some Cedar Fair. But then the logical side of me was like, you know what, Ian? You created that ride or die list for a reason. And whoop, is Cedar Fair on there? No, it's not. Okay, you're not buying it. It's as simple as that. That's why I do it. That's exactly why I have the list. And the list is there to safeguard me from stocks that literally have faced some fundamental changes that I don't know how they're going to resolve. Now, the nuance, though, here is I have a pretty big portfolio. I have 44 stocks. I've already got exposure to stuff. I already got Cedar Fair. I don't need more Cedar Fair. I've already got oil. I don't need more oil. And so my focus has always been on the stocks that I'm sharing here, ride or die. And I'll do an updated stock portfolio soon so you see percentages of everything. But the bulk of my money, it's in these types of companies. It's not in the oil. It's not in the banking. I like exposure to it, but I don't need to go overboard in those sectors, especially now that there's these fundamental warning signs out there. But again, if I were just starting out and I were a different age, maybe I were a lot younger, I was more of a risk seeker. I'm not saying there's anything wrong with oil either. There's a lot of people that make a ton of money off of the oil industry one way or another. And I wish the oil industry well, for sure. And so that's how I'm looking at it, everyone. I know that's actually some changes from even how I was looking at it earlier this year. But when a fundamental change in the economy happens, I need to take notice. And so please share in the comments below how you're looking at it. What do you think about this whole crash, this correction, this situation that we're in? How are you approaching it? It may be completely different than me, and it probably is. And that's what's fun about the comments section below, because we're all chatting, we're all discussing our unique perspectives, and everyone here is in a very different situation. And so what works for me may not for you, and so on and so forth. But that's what makes it so fun. And I know my own strategy, it's always evolving. I bet you I'll be buying oil stocks one day again. Hey, things get bad enough, maybe I will pick up some shares. And so I always reserve the right to change course. And I've already changed course pretty early this year. I went into the year thinking I'm doing high yielding stocks, and now already just not even through one quarter of the year, I'm all about quality. I'm all about ride or die. And quite frankly, part of my strategy is dictated by the fact that I don't think the crash is over. I think there's going to be more panic. And when there is, all these quality names go on sale. And when everything's on sale, why not gravitate towards quality? That's just the strategy that works for me. Because what you see here on the screen right now with ride or die, I would be really surprised if any of these cut the dividend. And I would be really surprised if they didn't increase the dividend even during the toughest of times. Now, these increases might be really small, but on average, I expect these companies to raise those dividends. And that's why my core, my ride or die, will always be these types of companies. All right, everyone. In terms of full disclosure, I own the stocks mentioned today. I am long Johnson & Johnson, ticker symbol J&J, PepsiCo, ticker symbol PEP, McDonald's, ticker symbol MCD, Clorox, ticker symbol CLX, Duke Energy, ticker symbol DUK, Procter & Gamble, ticker symbol PG, Coca-Cola, ticker symbol KO, 3M, ticker symbol MMM, Kimberly-Clark, ticker symbol KMB, Starbucks, ticker symbol SBUX, HD, or Home Depot, ticker symbol HD, What else? I am long General Mills, ticker symbol GIS. I am long Royal Dutch Shell, ticker symbol RDSA. I am long BP, ticker symbol BP. Chevron, ticker symbol CVX. Wells Fargo, ticker symbol WFC. Sorry for picking on you, Wells Fargo. And United Technologies. I'm long United Technologies, ticker symbol UTX. I own all of those in my dividend stock portfolio, and I know I gave some of them trouble today and spoke down on some of these, but I love them all and I respect them all. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. Just sharing my journey here on YouTube for fun and entertainment. And if you're going to go out and invest in the stock market, please consult a licensed financial advisor first. It is possible to lose money in the market, and so everyone needs to assess their own personal situation. My situation is probably very different than yours out there. And so happy investing. Keep your head up. This is, thug life investing for a reason. This isn't easy. And people ask me, Ian, what's one of the hardest parts about dividend investing? I've been in this over 20 years. It's times like this. The strong investors find ways to get through the crash, the crises, and they emerge the other end of it even stronger than where they were before. And so that's how I look at it. I always have the optimism. I always have the long term in mind. And I look and I remind myself of how far I've come and how well I've done with my strategy. And quite frankly, it's because of times like this why I invest for dividends. I just cannot see getting through this type of scenario with another strategy than dividends. Now, I respect all the strategies out there, and I wish everyone well who may have a different strategy. But for me, I just the one of the silver linings, the takeaways of this type of scenarios, I think it educates everyone, and it reinforces the fact that, man, dividend investing, it really, really works if done properly, if done into super high quality stocks. Now, if someone just had a portfolio of oil only and, in my opinion, that's may work for some people, but that type of dividend investing obviously carries extreme risks and may not emerge out the other end of this the same way as a well-diversified portfolio. But a well-diversified portfolio of high-quality companies across many industries, dollar cost average over time, that's the type of dividend investing that I just can't personally see any other way than that. All right, everyone. I'll catch you in the next video. Let's have some great discussion in the comments below.